Fidelity, one of the world's largest asset managers with trillions of dollars under management, has come out several times in the press and stated that one Bitcoin could be worth $100 million or more by the year 2035. At the time of this video, this is 13 years away from now. Hi, I'm Kevin from cryptocollege.cc, and in this video we're going to dissect the Bitcoin business case and try and understand how such a large investment firm came with what seems like a crazy price prediction. To understand how Fidelity calculated that estimate, one must first understand the fundamentals of Bitcoin governance and specifically its supply. Bitcoin is a digital currency based on a computer code and a peer-to-peer network of participating computers, often called miners or nodes. These nodes validate transactions digitally and securely on what is called the blockchain. This eliminates the need for a third party of trust, such as a bank, to execute the transaction. Bitcoin is also often referred to as a cryptocurrency because the transactions executed on its network are secured by complex cryptography or encryption. In this video, we are not going to go further into the technicalities of how mining processes work, but if you wish to learn more about the inner working of the Bitcoin blockchain and the mining process, please check our video How Bitcoin Works. It is important to remember that the Bitcoin blockchain or peer-to-peer network is not dependent on central entities like a bank or a government. It is called decentralized because its core code, along with its governing principles, combined with all the transactions that the miner record on the Bitcoin public ledger, are replicated in real time on computers that are scattered around the world. It's called the blockchain because when the miners add new transaction data to the Bitcoin ledger, we say we add a new transaction block in chronological order, therefore forming a chain of blocks. It is also therefore deemed immutable, because if one miner tries to tamper with the data, all the other nodes run by miners around the world would see it and exclude the fraudulent block and miner from the network. Similarly, if a miner goes offline, it does not matter because all the other nodes run by miners would have the latest version of the ledger or core code, and they can continue to operate. When a miner comes back online, their node will simply download the latest version of the ledger and rejoin the network. The Bitcoin blockchain and core code have self-regulating mechanisms that adjust the mining complexity and energy requirement based on the number of participating miners. If there are a lot of miners, the complexity is high, and the power requirements are high, flushing out the most inefficient miner. If, however, there are not enough miners to secure the network, the complexity drops and lowers the barrier to entry. This self-regulating mechanism plays an indirect role in the business case by giving investors in Bitcoin the confidence that the network is robust and secure. Of note, however, is the fact that this self-regulating mechanism also causes the Bitcoin blockchain and its miners to consume a large amount of energy. We will come back on that point later in the analysis. Another fundamental principle of the Bitcoin blockchain, which is also hard-coded in its core code, is its total volume and issuance. At its core, the creator of the Bitcoin blockchain, Satoshi Nakamoto, has set a parameter that there will only ever be 21 million Bitcoin created. Because the core code that holds this rule is also replicated between all the miners, it cannot be altered. Similarly, trying to tamper with transaction history, if a miner or anyone tries to add more volume of Bitcoin, the core code change would not match with the code on the other mining computer and be rejected. So, what if all the miners colluded and agreed to change the volume, you may ask? Well, the technical term for an attempt act such as this is called a 51% attack. It would in effect take 51% of the miners to agree that the total volume should be increased to be able to change it. However, this is where we enter the economical fundamental of the business case. One of the main reasons why people or investors see value in Bitcoin is because its total volume is fixed. If miners hypothetically did succeed in changing the volume, investors would immediately sell their holdings and the price would collapse. Before diving deeper into that, let's first understand the issuance mechanism of Bitcoin, as it also plays an important role in the business case. Investors like predictability when it comes to their investment, and there is not much more predictable than the fixed issuance of Bitcoin. The issuance of new Bitcoins is also set by the core code and therefore decentralized and immutable. Participating computer or miner are paid for putting at the disposal of the Bitcoin network their hardware, their electricity, and internet bandwidth. When they validate a new transaction and add it to the Bitcoin ledger, roughly every 10 minutes, they receive two payments, one transaction fee and one blockchain fee. The transaction fee is paid by the person sending some Bitcoin to another person. The blockchain fee is a preset amount of newly created Bitcoin paid by the blockchain core code within the preset quantity of 21 million. One quick side note on the electricity used by the miners to process Bitcoin transactions, as this is often the subject of many debates on Bitcoin and its sustainability. Let's put this in perspective to understand it better. In 2021, YouTube and all its servers consumed annually 600 terawatt-hour with minimal effort made to make that consumption greener. The entire Bitcoin network with all its mining computers consumes 120 terawatt-hour annualized. So exactly 5 times less than YouTube. And the Bitcoin community is investing huge amount of money to make future mining as green as possible, with some source claiming that between 25 to 60% of its energy consumption is already green and carbon-free. When the Bitcoin blockchain was launched in 2009, the blockchain reward, also called block reward, was 50 Bitcoin per block of transaction. A block holds more than one transaction data, but the Bitcoin core code also holds a mechanism that reduces the block reward by 50% every 210,000 blocks. This principle is called the halving. And the first halving happened in November 2012, where the block reward was reduced to 25 Bitcoin. Since then, two more halvings have occurred, roughly every 4 years, one in July 2016 and one in May 2020, where the block reward was reduced to 12.5 and 6.25 respectively. The impact of these halvings event is a supply shock that caused the Bitcoin price to rally. This is a good opportunity to point out that a Bitcoin can be divided by 100 million, and that its smallest denomination is also called a Satoshi, or Sats for short. Bitcoin investors do not need to buy a full Bitcoin and can buy Bitcoin fractioned as small as Sats. This obviously opens up Bitcoin purchases to a much wider investment community, making Bitcoin a much more affordable and accessible asset. The Bitcoin public ledger allows anyone at any time to check how many Bitcoins have been created, or more specifically, mined. At the time of recording this video, just over 19 million Bitcoin have been mined, with approximately 2 million still to be created. The issuance mechanism for Bitcoin also allows us to calculate when the last Bitcoin will be created. And it is estimated that this will happen in the year 2140. This is because of the issuance halving principle previously explained. What is important to understand here for our Bitcoin business case is that its issuance is both very predictable and more scarce, as the number of Bitcoin that will ever be created heads towards its finite number of 21 million. Bitcoin is often called hard money because of its fixed volume and predictable issuance, as opposed to soft money like fiat currencies such as the USD or Euro, whose issuance is unlimited, but more on that later. Although to date 19 million bitcoins have been created, the actual available amount is more likely around 15 million. This is because an analysis of the Bitcoin public ledger shows that an estimated 20% have been lost forever. Bitcoins can be lost when owners lose their access to them. You might have heard stories of people trying to retrieve old hard drives after the price of Bitcoin reached a new all-time high. So how does this happen? Well, there are different options to store or safekeep your Bitcoins. They can be stored on an exchange, just like stocks, but unlike stocks, you also have self-custody option. Bitcoin can be moved out of exchange and stored into digital wallets that can utilize as a security a private key, which is just an alphanumeric sequence that acts as a password. Feel free to check our content on cryptocollege.cc for more information and detailed explanation on how this works. What is important to understand here is that if someone loses their private key to their personal wallet, they effectively lose their Bitcoin. Those Bitcoin still exist, but no one can access them. To use a simple analogy, this would be like launching gold coins into outer space. Does this gold still exist? Sure. Can it be accessed? Very unlikely. There are plenty of stories of people losing access to their Bitcoin simply by not being careful, or more dramatic circumstances by dying or not having prepared a way for anyone to retrieve the private keys as part of a well-planned inheritance plan. This is not to be confused with Bitcoin being stolen by thieves or scammers who manage to get access to the private keys. Those remain in circulation as opposed to lost Bitcoin. A key point to consider here is the combined effect of lost Bitcoin alone on our business case is that Bitcoin is even more scarce than people think. Okay, so let's recap the most important points covered so far from the supply side before going into the demand and pricing of our business case. First, the total volume of Bitcoin is set by its core code and made immutable by the blockchain technology. Second, the total volume of Bitcoin that will ever be created is 21 million, and its issuance is very predictable, with the last Bitcoin that will be created in the year 2140. Third, roughly 19 million of those 21 million Bitcoin supply has already been created, but access to about 4 million of them has already been lost, meaning only 15 million Bitcoins are in circulation at the time of this video. Now that you have a better understanding of the supply side, let's look at the demand side. There will soon be 8 billion people living on this planet, and there are roughly 15 million Bitcoin available in circulation. This means that only 0.2% of the population could own a full Bitcoin. Of course, many more could own a fraction of Bitcoin, but this already puts things in perspective. This being said, at its current price, roughly $20,000, owning a full Bitcoin is already out of reach for a lot of people. But let's imagine that all USD millionaires in the world, for whom $20,000 is not such a great amount of money, decide they just want to buy one Bitcoin each. Well, there is an estimated 60 million millionaires in USD in the world. This means that only 25% of them would be able to own one full Bitcoin. Imagine what would happen to the price of Bitcoin if 30% of the global millionaires decided they want to own one Bitcoin. And this does not even consider the wealthy individual and institution that could buy tens of thousands of Bitcoin as part of their investment portfolio. I think that this makes a very clear image of where we could easily see a lot of greater demand than supply. Let's forget about the millionaires for now, because why would they need Bitcoin? They already are a millionaire after all. So let's focus on people who are buying Bitcoin today, and this is mostly millennial, with estimates showing that more than 90% of crypto buyers are Gen Z or millennial. Put another way, some analysis show that up to 40% of millennials now own cryptos, and Bitcoins of course. So why is this so important for the future price of Bitcoin? As so many of them already have crypto, it can no longer grow substantially. Well, this is important because of a phenomenon called the greatest generational wealth transfer of humans' history. It is estimated that between 30 and 70 trillion dollars of wealth is going to be passed on from baby boomers to millennial and Gen Z in the coming 2 decades. And that is for the USA only. With 40% of them already in Bitcoin and crypto, it would be fair to assume a small percentage of those inheritances will be invested in their favorite asset class, cryptocurrencies. To put things in perspective here, at the end of 2022, total market capitalization of Bitcoin was 400 billion USD and the total asset class was around 1 trillion USD. Therefore, even if a millennial from the US invests a small percentage of their future inheritance in Bitcoin, it could have a significant impact on price. Now, expand that thought to all millennial and Gen Z around the world, where in poorer countries the percentage of them invested in crypto is higher than 40%. At this point, I should perhaps address the reason for this younger generation adopting an appetite for investing in cryptocurrencies, which is basically that the inflationary effect of a government printing new soft money has led to the value of money declining in real terms over the years, which means that younger people can no longer afford purchases of home and are therefore seeking a way of breaking out of the catch-22 debt cycle that trapped them into a life of work and not much more to show for it. What is also important to factor in is that all those millennials around the world who are crypto enthusiasts will progressively have more and more lobbying power, even be involved in politics themselves. This is already starting to be visible globally, with younger pro-crypto politicians being more and more vocal. Okay, so let's have a look now at a chart that shows number of unique wallet addresses and their Bitcoin holding over the years. The blue line shows the price of Bitcoin and the red line shows the number of unique address, or crypto account if you prefer, holding some Bitcoin. The trend is clear and does not seem to slow down even when the price pulls back. And the beauty of that data is that it can be trusted because it's based on the Bitcoin public ledger, and this cannot be manipulated. All the demand for Bitcoin we have talked about so far is really about retail investors. But what about institutional investors? Well, with time, more and more of them will want a piece of the pie. Some studies show that they might already account for 10% of the existing volume, with 2 companies famously leading the way, with Grayscale Fund that holds 640,000 bitcoins and MicroStrategy that owns 130,000 bitcoins. This means that these 2 companies on their own own roughly 5% of the total supply of the 15 million bitcoin in circulation. Think about that for a moment. These 2 institutional investors holding what equates to 770,000 bitcoins. Or put in another way, our millionaire club just reduced even further. But why are institutional interested in Bitcoin? Simply put, because Bitcoin is becoming an investment edge that they can no longer afford to miss. The average performance of Bitcoin since 2009 has outpaced all other asset classes. What is important to understand here is that a well-balanced institutional portfolio always has a small percentage of assets with high risk, high reward, or even assets that are uncorrelated from traditional financial products. More and more Bitcoin and other cryptocurrencies are playing this role for institutions. Lately, even countries and governments are also jumping into investing into Bitcoin, with El Salvador famously making Bitcoin legal tender on par with the US dollar in their country. Alright, so let's do another quick summary of what we have learned from the demand side. 1. More than 40% of millennial and Gen Z are already invested in cryptocurrency. 2. Millennial and Gen Z are about to inherit trillions of dollars from boomers over the next 2 to 3 decades, and will most likely put a small percentage of that in Bitcoin and cryptos. 3. On-chain analysis shows a steady increase of self-custody of Bitcoin even through bear markets. 4. Institutional investors are also moving in and could already hold up to 10% of the Bitcoin volume, investing into crypto to hedge their portfolio. So what does all this mean for Bitcoin's price? Well, now that we have established that the demand for Bitcoin grows steadily and could continue to do so for the foreseeable future, with millennials and Gen Zs getting wealthier and continuing to invest a part of their wealth in Bitcoin, and to factor this against a fixed and limited volume, let's take a look at some basic projection calculations. If we completely eliminate the year 2010 Bitcoin growth of above 9,000% to try and have a more conservative approach, and start with the price of Bitcoin on the 1st of January 2011 at $0.3, and then take its closing price at the end of 2021 at $47,000 and calculate how much the price grew on average per year, we find a compounded annual growth of 197%. Now, just for test purposes, let's extrapolate that average annual return all the way to 2035 to see how this compares to Fidelity's valuation of 100 million per Bitcoin. If we do that, we find a price of more than 60 billion per Bitcoin. This is an interesting data point. But why does Fidelity's projection then appear to be so much smaller at only $100 million per Bitcoin in 2035? Because we must factor in that with adoption and more people holding the asset, the price volatility of Bitcoin diminishes, and so does the difference between the market cycle bottom and new all-time high. A good testimony of that is that in 2022, Bitcoin has become less volatile than the S&P 500 for the first time. So, if we consider as a starting point the value of Bitcoin on 1st of January 2022 of $47,000, and we then reduce the compound annual interest rates by more than half to 80%, we get $100 million per Bitcoin in the year 2035, with 80% annual compounded interest rate. If we bring the current compounded average annual growth from 193 all the way down to 26%, a Bitcoin would be worth $1 million by the year 2035. Now let's get back to our global millionaires for a moment and factor in inflation in our business case. For simplicity, let's take a millionaire that owns on January the 1st, 2022, only 1 million USD. How much buying power will he or she still have by the year 2035? Well, let's check that with what the inflation should be, about 3% compounded annually. This would give our millionaire a buying power of 673,000 US dollars by the year 2033. But what if major economies struggle to bring back inflation down to 3% because of the massive debt to GDP ratio they must service nowadays? And let's say that between today, where it's above 8%, and 2035, inflation averages out at 5% annually. Well, our millionaire would then have a buying power of only $500,000 USD. So what could he or she do to protect herself or himself against inflation? They could spend on the 1st of January 2022 $24,000 US dollars on half a Bitcoin and bet on a conservative growth of its value of 26% compounded annually to offset a 5% inflation. Is it guaranteed that Bitcoin will grow at 26% compounded annually until 2035? No, it's not, but it's a conservative estimate considering adoption and the current average annual growth of 197%. And what is guaranteed is that our millionaire buying power will be at best 673,000 by the year 2035, or at worst, under $500,000. So now I ask you this. If you were that millionaire on Jan 1st, 2022, would you spend 24,000 US dollar to have a high probability to offset inflation completely, or at least significantly? Well, more and more of them are starting to think that way and buying bitcoins, thus reducing everyone else's ability to own or buy a full bitcoin. You might think, I'm not a millionaire, I don't care. But what is true for $1 million is also true for 100,000 or 10,000 US dollar. And Bitcoin can be bought at a fraction of 100 million and help you offset inflation, whatever the money you have on your account. Before concluding, let's quickly have a look at what could put an end to Bitcoin's run. There are potentially three major threats to Bitcoins. The first one is cracking Bitcoin's encryption with quantum computing. Simply put, quantum computers are super powerful computers which are based on the principle of quantum theory. Although this would theoretically be possible, it remains unlikely and quantum computing is not expected to impact our lives for another decade or more. And when they come around, the security protocol of Bitcoin can also be upgraded. The second threat is a 51% attack that we have discussed in the first part of our business case, where there is a malicious attempt to be in control of more than 50% of the Bitcoin blockchain processing power to be able to alter the core code. Although again, theoretically possible, this is also unlikely because the cost to gather so much computational power would be in billions of dollars for no reward, as it would collapse the price the second the network identifies the malicious alteration. The third and most likely threat to Bitcoin is a legal ban by governments. Governments can make ownership or exchanging of Bitcoin illegal, just like the USA made buying of gold illegal in the 30s. But because of Bitcoin's self-custody principle, it can be made illegal, but it can't be stopped or controlled. This would simply make conversion back to fiat currency more difficult. We already have a good example of that in China, where it was made illegal, but blockchain data shows that roughly 10% of Bitcoin exchanging are still active in China, more than a year after the ban. Bans are expected to come and go in different countries over time, but as millennials progressively increase their lobbying power and access to key political roles, we can also expect acceptance of Bitcoin and other cryptocurrencies over time. So in conclusion, when one looks at the limited and controlled supply side of Bitcoin and put it against the growing and steady demand fueled by more and more people and institutions understanding that it can be used as a speculative investment or as an hedge against inflation, it becomes a lot clearer why Fidelity believes the price of one Bitcoin could reach 100 million USD by the year 2035. These predictions made by Fidelity were done in 2021, way before inflation exploded, essentially reinforcing their statement. And inflation is here to stay, as the American economy now requires 3 units of additional debt to increase its GDP by 1 unit. This has resulted in the US Central Bank printing much more than 50% of the total volume of US dollar ever created during the last 2 years. As a result, it now becomes more and more risky to not have a small portion of one's portfolio hedged with Bitcoin than the inherent risk of buying the asset for people in stable economies. And it's a precious solution for people with collapsing currencies such as Lebanon or Argentina, just to name a few. I hope this video and Bitcoin business case was useful to you, and if so, please share it with people who might find it interesting. If you want to learn more about Bitcoin or other cryptocurrencies, please visit cryptocollege.cc and I'll see you in the next video.